Strategist expects U.S. recession by year-end. Fed investment bank MPS Capital Services has warned that the U.S. economy will be in a recession by year-end. The firm's strategist predicts that the Federal Reserve will raise interest rates by an additional 25 basis points, warning that the central bank's monetary tightening will drag down on the economy. Strategist recession and rate hike predict tightening to drag down economy. He expects the U.S. dollar to depreciate by about 3% against the euro in the coming months due to the Federal Reserve's interest rate hikes, the news out.
Back to before SVB's collapse when they had to pause their, I think, financials, trying to wait on approval from regulators. The issues are myriad and go back years. Why the reaction in markets today?
Well, Credit Suisse has been a slow-moving car crash, it seems like, for the last couple of years. And it's strange that what triggered it was not news or an announcement from Credit Suisse. It was just the Saudis saying, OK, we're done at 10%. We're not going to increase that. But in the context of the fragility of all these financial institutions, obviously triggered that. But at the end of the day, the Swiss government is probably going to back first. I was about to say First Boston, right, but Credit Suisse. But I think that we have to sort of separate the viability of these banks, European and the U.S., versus, which I don't think is in question, and I don't think depositors need to worry, but what's the profit outlook? What's the loan outlook going to be? What kind of equity raises are these banks going to have to do that's going to dilute shareholders, but at least save their banks? And what kind of duration risks are now going to get fully exposed?
There is no way you can think the economy is going to grow today as much as you thought a week ago. And Goldman, Nancy, tried to put some numbers to this, estimating, okay, if the affected banks pull back 70%, the other small banks only pull back 15% on loans, maybe you only have a quarter-point drag to GDP. It seems pretty conservative. I mean, this is starting to feel like a faster, slow-motion credit crunch.
Totally. I think what we know is that bank lending standards have already tightened. And we also know that small businesses are pressed. And so the question is going to become, what happens? Well, I run a small business. What happens? You lay off employees. And so I think long term, this gets us where we need to go. It has an impact on inflation that will be disinflationary ultimately. But in the meantime, it's going to be very important to know what you own, to know the management teams. I mean, what happened at Silicon Valley Bank was a rookie error, a basic banking 101, match your assets and your liabilities. They didn't, and they are in a sense getting a do-over for their depositors, which is good news for the depositors, and that will help keep payrolls going in Silicon Valley. But I think we thought we would see a recession this year. We've said that consistently. I think now we know that we're going to see a recession, and the question is, what is the Fed going to do about it next week?
And Peter, I'm reminded it was just a week or two ago we were sitting here and talking about how those rate hikes hadn't fully been felt by the economy yet, and they were metastasizing, and here we now see more evidence of that. So should the Fed cut with inflation at 6%? Because we can check the break-evens, for instance. It's not like you see them taking off because we're now pricing in a pause. Mm-hmm. We're not pricing in a pause and seeing the market go, oh, you know what? We're going to take the break-evens up to 3 or 4% next year. They're still probably below 2.5, 2.3. Maybe they're even down towards 2.
Yeah, the 5-year break-even, last time I checked, was about 230 today.
Here it is, yeah. But
they're not going to go from raising to immediately cutting. They should, from a risk management standpoint, they should be doing nothing next week.
Right.
Now, I know symbolically they may feel from an institutional standpoint, hey, we've been talking so tough in inflation, we got to throw one more out there. But from a risk management standpoint, they should stop. Yeah. Now, shifting to the decline in interest rates, well, that's a tougher pull for them because of this rate of inflation that, yes, will still continue to moderate. But this is different this time in the sense of the Fed's ability to address an economic and a credit or a banking challenge with let's just cut back to zero and start doing QE again.
Right.
Those tools have been taken away from them with inflation where it's at.
Andy, jump in here.
Sure. So I think what's happening today is the market's responding to the Fed's job getting done by something else. The Fed's job used to be hike rates until inflation drops to a more manageable level.
Right.
Now there's a potential banking crisis brewing that could do the Fed's job for it.
Absolutely.
And that gives the Fed cover to pause and eventually start to cut rates.
But it's odd because you're right. They're doing the job for the Fed, and yet the Fed.
The Nasdaq and S&P also had a good day. The Nasdaq climbed around 3%, and the S&P is up more than 2%. Joining us now is Matthew Luzetti. He is a chief U.S. economist for Deutsche Bank. Matthew, thanks so much for joining us. Earlier this month, Deutsche Bank became the first major bank to forecast a U.S. recession. Then earlier this week, that prediction was updated to a massive recession. Then today, the U.S. Commerce Department reported that GDP declined for the first time since 2020. Do you think this is further evidence that a recession is imminent?
Sure. First, thanks so much for having me. I think what is important here with this morning's print is, yes, it was negative. We were down minus 1.4 percentage points. But the composition of that was really driven by a few items. It was driven by net exports and trade data, which has been quite volatile. It was also driven by inventories, where we saw a bit of a destocking, and actually government spending. We tend to like to focus on those measures of private domestic demand, consumer spending, housing, business investment. And when you do that, those numbers are actually quite strong, growing 3.7% annualized when you look at those three items together. Net exports alone subtracted more than 3 percentage points. So no, we do expect that we're going to see a recession by the end of next year, but this was not the start of it. We do expect that you're going to continue to see relatively solid growth throughout the course of this year, around 2% on average over the course of this year, and that the economy should bounce back in the second quarter. And so what are some of the factors that your bank is watching it's led the bank to believe that this massive recession is imminent? Sure. So for us, really it is all about the inflationary pressures that we are seeing in the economy and the likely necessary response that we have to have from a monetary policy perspective. And so it is actually the strength in the economy, the strength in the labor market, which we saw again today with jobless claims remaining near record lows, the strength that we've seen in the labor market with the unemployment rate at 3.6%, measures of labor market slack basically at historically tight levels, and the fact that that is feeding into broadening wage and price pressures, which suggests that the Fed has to get more aggressive. We expect they're going to be more aggressive next week, raising rates by 50 basis points. We expect they're going to follow that up with 2 more 50 basis point rate increases in June and July, and that they'll have to bring monetary policy to a restrictive stance by the middle of next year. Our baseline estimate is a 3.6% Fed funds rate, and that is kind of a necessary monetary policy response really to get inflation pressures back down. The byproduct of that, I think, will be our baseline is a mild recession towards the end of 2023, with risks that it is more severe if inflation pressures really do not subside at all.
Great. Matthew, is there anything U.S. officials can do at this point to prevent a major economic downturn? And if so, what?
It's a very difficult one, and it's a very difficult one because the typical things that you would anticipate to prevent the downturn would be providing support for demand. And really it is demand, an overheating economy. It is too much demand relative to supply that is creating the issues that central bankers are dealing with today and that policymakers are dealing with today. It's creating the price pressures that we're seeing, several decade highs for inflation, very rapid wage gains. And so the typical policy response, which would be easing policy or providing some income support, is not what is needed right now. On the other hand, things that can help to alleviate supply chains would be helpful. Things that would help to bring people back into the workforce would also be helpful. But I think ultimately we don't think that price pressures are simply going to subside due to what's happening on the supply side of the economy. Really what will ultimately be needed will be tighter monetary policy. Fiscal policy will tighten this year relative to last year, and that will be the ultimate source of the downturn that we anticipate next year. All right. And again, ending the day in the green today, Dow sitting up about 600 points. Matthew Luzetti, thank you.